Hello everyone! Today, I'd like to share a conversation that reflects the situation commonly encountered during my discussion with high net worth investors recently. The investor follows the financial markets closely and has spent considerable time researching artificial intelligence, defense, and technology-related industries. He recently purchased several thematic investment products through a brokerage platform. The investments had recently performed favorably relative to his expectations. He asked me a straightforward question: if investors can research industries themselves and identify investment that appears consistent with their views, what additional value does a professional financial advisor really provide? I think his question was reasonable. Many investors can research markets and select investment products on their own. This is especially true for investors who have spent years studying a particular industry, possess relevant professional expertise, or are simply willing to devote the time to learning. In certain specialized areas, an investor may have industry knowledge or professional experience that an advisor does not have. So, I told him, you can certainly continue researching the areas that interest you. The value of professional advice should not be based on dismissing an investor's abilities or claiming that an advisor can always identify better investments. The real question is not whether you can identify an investment with attractive characteristics yourself. The real question is whether such investments are coordinated when managing a family's wealth over the long term. The conversation shifted from selecting investments to managing an overall wealth structure. I asked him what percentage of his total investable assets these thematic positions currently represented. He estimated that the allocation was already larger than he had originally thought. I then asked if these thematic investments represent 30% or 40% of your total portfolio. Would you continue holding them? Or would you begin trimming those positions and rebalancing your portfolio? If these investments were all to decline by 30% at the same time, would that affect your retirement plans, your family's lifestyle, or any significant cash needs over the next several years? He acknowledged he's never really thought about those questions. At that point, our discussion became a discussion about the role these investments should play within the overall wealth structure. That is one of the issues portfolio customization is designed to address. An attractive individual investment does not automatically create a well-constructed portfolio, because a well-constructed portfolio must consider far more than expected returns. It also accounts for asset allocation, concentration risk, correlation, liquidity, investment time horizon, and how the investments support a family's long-term financial goals. Then, we reviewed the underlying holdings of these investment products together. Many investors own an artificial intelligence fund, a semiconductor fund, a technology fund, a large-cap growth fund, and a NASDAQ index fund at the same time. On the surface, there appear to be 5 different investments. But once you take a closer look, you often discover that they are repeatedly invested in many of the same large technology companies. The number of funds has increased, but the true sources of diversification have not. Many investors believe they have diversified their portfolios, when they are simply holding the same stocks through different fund names. That's why professional portfolio analysis focuses not on the name of an investment product, but on questions such as, how much overlap exists among the underlying holdings? What percentage of the portfolio is concentrated in a single company or industry? Has the overall portfolio become overly exposed to growth, momentum, or other investment factors? If the technology sector experiences a broad correction, are all these investments likely to decline together? These are the works of portfolio analysis, portfolio customization, and risk management to help investors. I explained to him the strong performance of his investments simply tells the market environment has been favorable for these investment themes, and both his industry research and the timing of his investments have worked out well. But they do not fully validate a long-term investment strategy, because the real test almost always comes later. If these investments rose another 20% or 30%, would you continue holding them, increase the positions, or gradually reduce the exposure? If they declined by 25%, would you treat that as a possible buying opportunity or revisit the original investment thesis to determine whether it remained valid? And if the long-term outlook for the industry remains attractive, but market valuations have become excessively high, how should you respond? This investor did not yet have clear answers to those questions. I told him that having conviction about an industry is extremely important. However, the long-term development of an industry and the investment returns generated from that industry are not the same thing, and they often do not move in perfect alignment. Many self-directed investors have very clear reasons for buying an investment, but they often do not have equally clear rules for adding to positions, reducing exposure, or eventually exiting those investments. In long-term investing, the greatest challenge is rarely deciding when to buy. More often, it is knowing how to hold, when to adjust, and when to exit. AI continues to influence industries and markets over the long term, but that does not mean every AI company will succeed, nor does it mean every AI fund is worth buying at any price. Actual investment returns depend on many additional factors: which companies the fund owns, how the index is constructed, the weighting of its largest holdings, current market valuations, how much future growth has already been priced into the market, and ultimately the prices at which investors buy and eventually sell. The same principle applies to defense investments. Defense spending could increase over time, yet individual companies may still be affected by government budgets, procurement cycles, project delays, cost pressures, and changes in public policy. Industry research helps answer the question, where might future opportunities exist? Professional wealth management must answer a much broader set of questions. How much should you invest? At what valuation? In which account should those assets be held? How much risk should they represent within your overall portfolio? When should the portfolio be adjusted? And when should you exit? Our conversation shifted to the important topic, taxes. I asked him to imagine what might happen if these thematic investments continued to appreciate and eventually generated several $100,000 or even more in unrealized capital gains. How would he plan to exit those positions? Selling everything at once could create a significant tax burden. On the other hand, never selling could cause an increasingly large concentration of wealth in a single group of investments. At that point, investment management can no longer focus solely on market performance. It may also require consideration of tax-aware investment approaches in coordination with qualified tax professionals. For example, an investor may evaluate an annual capital gain budget that identifies how much gain may be appropriate to realize in a particular year. They may consider tax loss harvesting where appropriate to realize losses that may offset certain realized gains. They may also consider deferring the realization of certain gains when future tax circumstances may potentially be more favorable and consistent with their investment objectives. In addition, they may also evaluate tax-aware approaches for portfolio rebalancing. I also explained that when an investor needs cash, an advisory team may evaluate available accounts, tax lots, cost bases, investment considerations, and anticipated tax consequences to identify a potentially more tax-aware withdrawal approach, working alongside the investor's tax professional. Another planning strategy, often referred to as asset location, involves placing different types of investments into taxable accounts, IRA, Roth IRAs, SHAs, or other account types based on the characteristics of the assets, an investor's financial goals, and tax considerations. In certain lower income years, an investor may evaluate whether intentionally realizing a portion of capital gains could produce a more favorable tax result based on the investor's circumstances and applicable federal and state tax rules. Professional advisory teams may also provide a wide range of tax-efficient planning strategies, including direct indexing, custom indexing, exchange funds, charitable giving strategies, and other planning alternatives designed to address concentrated stock positions. These strategies' availability and suitability depend on each investor's individual circumstances, eligibility, financial goals, and the specific planning services available. No single strategy is appropriate for every investor. The potential benefits, risks, costs, tax implications, and implementation requirements of any strategy should be evaluated based on an investor's individual circumstances and a personalized planning process. Any strategy should also be considered within the context of the investor's broader financial goals and overall financial plan. At this point, the investor began to realize that he had been focusing primarily on the investment returns in his account. What we were discussing was something much broader: how much of those investment gains could ultimately become long-term, after-tax wealth that his family could preserve. For high-net-worth families, what matters most is not simply gross return. An important consideration is how investment results interact with taxes, advisory and investment fees, financing costs, risks, and future spending needs. Then we broaden the discussion to his family's entire balance sheet. In addition to these investment funds, he also owned other taxable investment accounts, retirement accounts, real estate, cash reserves, and future retirement income sources. His family also had clearly defined cash flow needs over the coming years. We need to answer a much broader set of questions together. Are the assets that will be needed soon taking on too much investment risk? Are there unnecessary overlaps between the taxable portfolio and retirement accounts? Which assets should be dedicated to long-term growth? Which assets should be positioned to generate stable income over the next several years? If the market experiences a significant decline, would the family be forced to sell growth assets at the wrong time? Once retirement begins, where should annual income come from? Which accounts should be withdrawn first? Which accounts should continue to benefit from tax deferral? At this point, the discussion had moved beyond investment selection and into broader retirement income and cash flow planning. I explained that the professional advisory team can help investors evaluate their overall wealth structure from multiple perspectives, including planning for short-term liquidity needs, developing a sustainable income strategy for the years ahead, and positioning assets to support long-term capital appreciation. For investors with more specialized needs, advisory teams may also provide access to alternative investment solutions, which may include private credit, private equity, infrastructure-related investments, interval funds, and other specialized investment strategies. Also, the risk management provided by professional advisory teams involves more than insurance planning or attempts to manage market volatility. It may include evaluating concentration in individual sectors and securities, maintaining liquidity reserves, seeking to reduce the risk of forced sales during unfavorable market conditions, reviewing leverage and financing risks, and coordinating investments, cash flow, retirement planning, insurance protection, and wealth transfer considerations. Finally, I introduced a type of arrangement is commonly described as a core satellite structure. The core portfolio is designed by advisory team for the investor family to pursue long-term growth, broader diversification, tax-aware management, and cash flow objectives that are aligned with the family's long-term financial plan. The satellite portion allows the investor to continue expressing personal investment views and remain involved in managing part of the portfolio. For this investor, advisory team and him establish a framework in advance. Consider what percentage of the overall portfolio may be allocated to thematic investments, determine an appropriate maximum allocation for any single investment theme, discuss under what circumstances additional investments should be made, when positions should be reduced, when the investment thesis should be re-evaluated, and under what conditions portfolio rebalancing would take. This approach allows investors to retain control over their investment decisions while establishing appropriate portfolio parameters that can help manage the risk of excessive concentration in any single investment theme over time. It also facilitates a more coordinated approach to portfolio transition planning, capital gains management, tax planning, retirement income planning, family financial goals, and long-term wealth transfer strategies. Key takeaways from our discussion: self-directed investing and professional wealth management are not necessarily opposing choices. A thoughtful investor can continue making independent investment decisions, pursue areas of personal interest, and remain actively involved in managing part of the portfolio. The role of a professional advisor need not be to replace the investor's judgment. Professional advice may help investors evaluate a broader financial picture, apply a more structured decision-making process, and consider investment decisions within the context of a family's long-term financial plan. A client may very well be capable of selecting excellent investments, but professional wealth management is designed to answer a different set of questions. How large should each investment position be? What role should it play within the overall portfolio? How should risk be managed? What planning opportunities may help manage after-tax outcomes? How can today's investment decisions support tomorrow's cash flow needs? And how can different financial decisions be evaluated and coordinated in support of the investor's family and long-term objectives? Because wealth planning involves more than managing a fund, a stock, or an investment account. It involves considering the wealth a family builds over time and the life that wealth is intended to support. I hope this video has encouraged you to think differently about the relationship between personal investing and wealth management. In future videos, I'll take a closer look at selected planning approaches and tools discussed today, the considerations they are intended to address, the circumstances in which they may or may not be appropriate, and their potential advantages, limitations, costs, and risks. Thank you for following. I look forward to seeing you in my next video.